Today's example is on a cash secure put strategy, and I've been talking about them a lot, mainly because we're kind of in that place of the market where the price of stock have gone up quite a bit, and we need to make a determination if we're going to sell some, what should we do with those dollars. So first step is this: we started off with a portfolio of 27 stock, 27 companies we loved, 27 companies that diversified the portfolio, and we served a big purpose in our long-term investment strategy. But since then, 14 of them that we bought below intrinsic value are now 15% or more above intrinsic value. That's where we want to make the determination: should we sell some of them? Should we take some of the gains? Should we take some of that profit and some of the risk off our plate? So let's just say we rebalance the account, we sell, and now we have cash sitting in our account of $932,000. We didn't sell everything, but we certainly sold a decent portion where we have now cash. When the cash gets sold, what do we want to do? Well, we want to invest it first in a risk-free investment. So that's why they're called cash secured. You need to have something that's considered risk-free, that your brokerage allows you to be able to still earn interest, but in the event that the stock gets put back onto you, you have the cash ready to go. So you're now invested in the risk-free. That whole $932,000 goes into there. You might be getting an annual rate of return of something like 3.5%, depending upon what interest rates that are at the time. So you right away are getting interest. And then on that, you sell the puts. The put price is set, and then you want to set how long is the contract. In this case, we did a 75-day contract, and at the price that we set, we collected $21,046. So from this $932,000, we're making our interest from our risk-free, and we got an additional $21,000 that covers the period of 75 days. Now, a couple of additional important things is, like I said, we set the price at when we want to buy it. That's how we created our strike price, is the price that if it gets put on us, we want to buy it at anyways. And another important thing is at the end of the 75 days, what will happen? Well, either you end up buying the stock at the price you wanted to buy it at anyways, that's the price that gets put back onto you, or it expires. And then you just have your premium, and we can make a decision: do I want to do another contract for 75 days? Do I want to buy a different stock? You can do whatever you want to at that time with all that cash. So I have 4 very important things that at least I think are important when it comes to this strategy. Is first, almost all the work that you're doing is on the stock analysis. The stock analysis is the day-to-day job. Like, you got to make sure that there's 27 companies. These are companies that you want to own and probably are owning, and you don't want to have to buy a stock at a price that you don't want to own anyways. So some people, when they're looking at selling puts, they're just thinking, oh, how much premium can I get? And what's going to give me most premium? If you want to reduce some of the risks, you're setting on good prices at companies you like, and you're not even really thinking too much. You're just collecting the premium. The premium is what it is. It's a way to get a little extra money rather than just getting interest while you're kind of sitting on the sidelines waiting for that opportunity to buy the stock. And then I already kind of mentioned this, but you want to do it with stock that you own at the price that you want to buy it. And where are the risks at? So let's talk about risks. And probably the biggest risk is the length of contract that you set, in addition to the stock itself, but the length of contract. So even right now, if I like the stock quite a bit, but I said, say, a year contract versus a 75-day contract, one thing is that you may miss your opportunity to buy, meaning that you wanted to buy that stock at 75 bucks. After 3 months, it goes down to 75 bucks, and maybe even, but then it goes back up. You still have to hold the contract, so you miss that opportunity. That's one reason why a shorter time period is less risky. Another reason a shorter time period is less risky is because you have company risk. You maybe love the company right now, but it could be 6 months from now and there's some sort of announcement made. And now the company's like, I wish I could sell it, but you can't sell it if you have it tied up to a cash secured put. You can sell the put to get yourself out of the obligation, but you will lose money. So the longer the contract, the bigger the risk. That's why we did a 75-day contract. And then this is this kind of understanding. If you're thinking about, well, should I hold the stock or should I hold a cash secured put? What's the probability? If a stock is really overvalued and you're looking at, I'm going to take some off my plate, there is a decent probability that you may find an opportunity down the road to buy that stock at a cheaper price. It's just the nature of stock. They're volatile. is oftentimes they run way above their intrinsic values, and then a lot of times they'll run below the intrinsic value. If you set that price, there can be that opportunity that you can buy it back. At least that's what history has shown. And it isn't a bad thing. Plus, if you're getting the premium and you're getting the interest, then you're still collecting and getting a rate of return. So it's not like you're sitting on cash or really timing the market that much. It's just now an alternative a way to take some gains. And that's how we did it in this particular case. And I just want to show some of the numbers behind it.